is just that it's a prisoner of a monopoly income stream from its Windows base.
It's legacy, right?
Right.
Hey, William, I just want to add to that. For those who don't know, what's fascinating here is Nokia had over 40% market share of the world market.
Yeah.
Okay.
Like 3 years ago, it had over 40%.
They had more than the next four combined.
Well, Nokia used to have a $240 billion market cap. It used to be one of the two most valuable non-American companies in the world.
You're faster than Wikipedia.
All right, we are going to jump off from the mobile side. Of course, that's a super exciting part of where technology is going. What's that?
Nothing. Go ahead.
Okay.
Brian was
William, just let me finish up.
Oh.
Since Apple and Google, Android came onto the scene, they've gone from 40% to 32% in just like 2.5 years. And the sad part here is it took Nokia 4 years to respond to the iPhone. And
yeah.
if I had a place to bet, I think what you're going to see, and this is something you rarely see, you're going to see a giant go down, long term.
Nokia, you mean?
Yes.
And if anything, right now, the bottom of the pyramid, if you think about the top being all the smartphones, the bottom being these $20 and $40 phones, Nokia has been living in that area right now, and that's unfortunately not a totally sustainable environment, other than micropayments and banking, which is extremely hot.
Right.
And Microsoft gets that platform part of the deal, which is another part. I mean, it's amazing what Microsoft got on this deal. It's substantial to give them a brand new foothold in industries they couldn't touch before, or areas.
But,
yeah.
But Apple has 140 million credit cards, and Nokia doesn't.
No,
Yeah, there's clearly some challenges for those guys.
Statistic about how many months a cell phone has 80% of its revenues. As of 3 years ago, it was averaging between 3 and 5 years. They reached 80%. Now it's 5 to 7 months. So the new models
It's all apps.
are changing the economics because that's all underwritten by the carriers for the redistribution of those iPhones.
That is interesting. A couple other interesting stats here. So Google Ventures, they've said this year they're going to do 30 deals, new deals. I find it interesting because I'm looking at the deals they're doing, and very little of them are related to like strong computing or storage or even search. They're just looking at everything. And I think the mandate there just, there's a paranoia within Google because they're students of technology history. They've seen how the giants, the ones we just talked about, have all collapsed. And the reality is they all know eventually their day will come too. There's just no way around it.
But getting money from Google, would it be almost like getting money from Steamboat? Meaning once you get money from a certain VC that's attached to a giant company, does that isolate you from having an M&A or some type of partnership with other companies?
Yeah, it's a great question, but I would say it's, with Google Ventures, definitely not.
Free office space.
Yeah, and free office space. But no, most strategics, if you want to call them that, strategic investors, they have a shitload of strings attached. You want to work with Cisco, you want to work with Adobe, you just have all kinds of strings. I don't think Steamboat really has any strings, or very few. They're mostly benefits. So Google is modeled after Intel. Intel has been in the venture business for like 30 years, more than most VC firms. They have thousands of investments, and they have a financial mandate. It's not a strategic mandate, and I think that's actually a good thing. I think that's the only way you can long-term keep that particular type of business strong, and it actually probably helps if there is not a Chinese wall there, and if the Google venture team actually communicates with people within Google. That would be a very useful information transfer. And I think they're saying they're putting $100 million to work, which of course is off their treasury, not off their income statement because it's investments. I actually think it's a great idea if you have the excess cash and you're earning 30 basis points in a T-bill.
Different than Tomorrow Ventures, by the way, which is Eric Schmidt's investment company.
Right. That's just his family office, which is purely a financial investor. A couple other things I thought were interesting here. I noted this week, PE ratios. Consumer products companies have been going up because the consumer is back spending. I talked a couple weeks ago about how credit card usage is going back up. No lessons learned from the financial crisis. Thanks to the American economy. But interesting. So consumer product companies have a 20 times multiple, 20 XP multiple. And Alex here always talking about innovation, how important it is. The pharmaceutical companies have a 10 XP multiple. And
That's a screaming buy.
it may be a screaming buy. I think part of the problem is, you know, pharmaceutical companies are so despised now. And people think they've been doing bad things. They're not trying to help. They're just trying to pump drugs out. But the long-term effect, I think, is very bad. When your cost of capital goes up, what you can invest in goes down. U.S. pharma companies lead the world in new pharmaceutical innovations. So I didn't think that was a good sign. And something I'll end with here.
How about the big IPOs?
The one, Kinder, right, the one we talked about last week, which was the gas pipeline company. They raised, it was over $2 billion.
$2.89 billion.
$2.89 billion, and of course gas prices are going up, and that company had a really good footprint. So it's nice that it's not just tech companies.
Right, Pandora?
We talked about Pandora last week. This week, of course, they filed for their IPO. Channeling Michael Robertson, he has always said that the copyright fees for music is their Achilles heel. And if you look at the 10K, it's substantial. 50% of their revenues go to royalties. That's a lot. To give you, I used to be the CFO of Disney's merchandise licensing division. We had a pretty good set of licensing properties. We charged 8%, sometimes 10% of gross revenues in terms of a royalty. So they're right now at 50%. That could go down. And it's 50%, of course, because they pay a fixed price per song. It doesn't scale. That's one of the issues with their model, unless they get very, very big. But people are very enthusiastic about that IPO. And you know, I read analysts saying it could be $1 billion, raising $100 million. Pretty impressive. They've gone, I think they're now at 90 million in revenues. 50 million of that is advertising. The subscription business is growing really fast. I love them because I think they're much better than listening to radio, so I want them to do well. But at some point, they're going to have a better deal with the music publishers.
You think Spotify will break in?
I don't know. I mean, that's UK, right? I mean, that's Europe. I don't know.
All he's doing is trying to get a foothold here.
He's trying, but he's having issues, obviously, on licensing.
Yeah.
But Spotify, if you haven't used it, it's an amazing service.
Is there any way to get it here?
Yeah, you could do a VPN. There's tons
Okay.
of VPNs that cost about $4 a month. And by the way, the VPNs, which are great about that, is once you get the VPN and you can get it so it looks like you're coming in from London, you can get things like the iPlayer, which is incredible. It's probably one of the best video portals that are out there, and other great tools like Spotify, because it makes it look like you're coming from the UK. So there's a bunch, just do VPN, London, and they're, like I said, about $4 a month, those networks.
My partner, I was reading a quote from him this week in an online publication called Paid Content. Some of you know that business. And I've been thinking this, but he actually, about Bill. All of the great ideas, or just about all of them that I see percolating right now on the web, Bill in his incubator in 95, 6, 7, 8 was thrown against the wall. Almost all of them. And he talked about, he just bought a Twitter, I think it was called TweetDeck. He just paid $25 million to acquire TweetDeck. I think he said 25% or 20% of all tweets go through that. It's an interesting model because Bill, of course, is an incubator, so he starts companies. I could see more VCs starting to do what he just did. What we usually do is we put a little money and see where something goes. The private equity guys go buy a business outright. But if you see great upside in that business and the funds are being raised again or getting a little bigger, it's not a bad idea. For $25 million, you own 100% of it. You can raise more money down the road. But he's saying, when they asked him what he's doing, he said he's opening up the old notebook from 1995 to 2000 and just taking out all the old models and repackaging them as new. Let's see, one point about just commenting on last week, where we had the Egypt
Something going to happen in India now?
Hopefully not.
Oh, okay.
India's solid. But I was just talking to Alex about this. The Mubarak has, I think the report is almost 70 billion. What is it? 66?
65.6 billion is the real number.
Right. So we won't get into all of the discussion here. But what is it about dictators of really poor countries always having like $50 billion?
It's a good job.
It is. It's a great job.
Imagine the search fee I get for finding one.
But anyway, there's a lot of discussion now that was the real problem. he was pocketing, and what does an 80-year-old guy need 70 billion for? That's a different story.
Chicks.
Yeah, chicks, lots of chicks. Charmel check on the weekends.
Pay a lot after 80. Get the 20-year-olds.
Yeah, so that apparently, there's a lot you could talk about that whole thing. Who knew they had 70 billion pocketed away, and why were we paying them so much money? Here's an interesting trend number. I just saw this in the announce report. 3 quarters after the product launch of the iPod, there were 500,000 cumulative sales. The iPhone, there were 2 million, and that, you know, so about the same price. And then iPad, which is clearly way more expensive, 14 million iPads, 3 quarters after the launch. So we talk a lot about Apple here because it's such a bizarre company, able to create brand new product categories. You know, the iPhone, a $40 billion run rate, and a zero in terms of their revenue 4 years ago. But the acceleration of how quickly those new products generate revenue is reflected there. 2 million iPhones sold cumulatively after 3 quarters of the launch, 14 million iPads. Lastly, on a humorous note here, does anybody remember the guy who wrote Dow 36,000? Does anyone remember this guy?
He was an academic.
Yeah. I guess he was an academic. I mean, well, in October '99, right, he wrote Dow 36,000. And the book was basically about, look how fast these companies are going up in value. Foundry Networks goes public, and a year later it's up 500%. So he basically extrapolated within a bubble. And he said, you know, in 3 to 5 years, Dow's going to be 36,000. And then, of course, you know, and he sold like a shitload of books. And then, of course, everything crashed and he went away. So
Got a new book.
now he's got a new book, and I'm like, this guy's timing is so awful. So his new book is called Safety Net, and it's how to avoid the pending financial crisis.
Unless he's talking about the next one.
Well, why is that funny? There is going to be another one.
Well, I guess so. But come on, right? It's like, why couldn't you have written that 3 years ago?
It's a different financial crisis.
Yeah.
All right.
All right, you buy the book.
Give
All
it
right,
up for William. All right.